So generally in an appreciating market, I think of it as being sprinting. Short, compact, it has a specific beginning and it has a specific end and it has a specific purpose, and you don't want to lose track of it. I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. Hi, this is Christina Suter with the Real Estate Breakthrough Show. Today, I want to talk about real estate education. Your real estate education is a really, really big piece to your real estate success. As a matter of fact, I would call it maybe, 70 or 80% of what defines your real estate success is your education and your attention. There might be 20, there is definitely luck in there. There's definitely things moving on you. There's definitely things occurring and coming to you. But if something comes to you and you are not educated about how to be able to respond to it, then you have a harder time being able to maximize that use, or maybe even being able to see it as an opportunity. So today I want to talk about investing in appreciating markets. Los Angeles, California, the whole county of Los Angeles, California in general is an appreciating market. Its chart goes up and goes down and goes up a little higher and goes down a little less low and goes up again and goes down. That is an appreciating market. With each recession, it generally goes down or at least flat lines, but generally there is a downtick. And with every growing economic market, there's almost always an increasing drive moving up in the charts. And one of the ways you can recognize that is this cyclical pattern, up and down, up and down. And the other way you can recognize is that generally the appreciation line, when it is appreciating, can be close to 45 degrees or higher. It is literally at an angle of 45 degrees. Think of your back in your days when you learned about triangles and what a 45-degree angle looked like. That's a 45-degree angle, and it will look that strong or higher. That is the key obviousness, or the keynote of what it means to have an appreciating market that you're looking to invest in. You can find this information on FRED, F-R-E-D, the St. Louis Federal Reserve. They have lots and lots of charts, so just type in FRED, housing chart 4, type in your city, and it will give you some version of a housing chart. And you can definitely recognize, especially if you watched my previous show, you'll definitely recognize the difference between an appreciating market and a stabilized market. Okay, so an appreciating market, I call it know your pony. What pony do you want to ride in an appreciating market? Or the pony you're riding is in an appreciating market. What race is it running? So generally in an appreciating market, I think of it as being sprinting. Short, compact, it has a specific beginning and it has a specific end and it has a specific purpose, and you don't want to lose track of it. So what does that mean? What that means is that generally the cycles are very tight. You want to purchase when you're at the beginning of a cycle, when it's low, either at the coming down the dip, at the bottom of the dip, or starting to raise out of the dip. Optimally, if you know you're purchasing because it's an appreciating market, you want to see that it's at the bottom, which generally it doesn't hang out there very long. Remember, there's a 3 to 6 month lag in being able to understand how a market is moving. Why a 3 to 6 month lag? It's because it takes 3 months worth of data to be able to be certain that there is a clear direction to the line or direction change in the line. And it takes another 3 months sometimes for that data to reach you, for LA Times to distribute it, for the Fed to give it validity, for your own market or real estate agent to give it validity. So it takes 3 months just to make the line. And it takes another 3 months potentially to even notice it and give it validity. So generally I find the general newspapers, the LA Times, your sort of public-based newspapers, are generally talking 4 to 5 months in arrears. They're talking back saying, hey, guess what? The last 3 months has been this, and now we think this is a significant churn in the market. They generally don't declare it at the third data point. If you go on something like Dr. Housing Bubble or Business Insider, you might find they're more willing to say, hey, this has been 3 months. Clearly, that's an important data point. Okay, so when you're seeing that a cycle has changed, when you're seeing it's changed its direction, generally you can wait that 3 months when it's down towards the bottom. By the way, the bottom's usually I mean, if you look at a chart, the true bottom of a chart is generally literally 2 to 3 months. And within that chart, you'll start to see some increases. Now, 2009 to 2012 was the longest bottom I have ever seen for a real estate downturn. And when I mean bottom, I literally mean the bottom. Like it literally went down in 2009 and it went across to 2012 and it went back up again. Generally, the bottom of a market, especially in LA, we're literally talking 3 to 6 months where it's going down, down, down. Now it's across for 6 months. And then it will start showing some increases on month 7, 8, or 9. So just be aware that when you're trying to catch what's called like trying to catch the falling knife, like you want to be careful. Do not try to truly get it right at the bottom. Do not try to think that you should be able to get it right at the bottom. Honestly, I want to see 3 months worth of it being across the bottom, and I want to see a month or two of it starting to go up. And then I go, yep, there we are. Okay, now I can start investing. What that means is because there is also generally a month to 3 month lag in purchasing a piece of real estate, I am now purchasing as it's starting to come up, and I still have a month to 3 month lag in my actual purchase. You know, these cycles are 7 years long, potentially 7, 9, 10. And we've seen some cycles as long as 15 years long. Who cares if I miss it by 3 months? Who cares if I miss it by 6 months? I am catching it as it's starting to go up and at the beginning of that cycle. That's lovely. I call that a success. So purchasing in an appreciating market, that's your optimal time to purchase. Now, selling is a whole nother conversation. So let's talk about that. You buy something, it's your pony, right? You're sprinting. You buy it when it's on towards the bottom. You want to sell it towards the top. How do I know what the top is? I did a video on this, the whole like laying out the actual indicators and showing you the charts. That is answered best in listening to that particular video. So go and find that one. And the way you know you're at the top is very similar to the bottom if you're looking at just price. Now, if you're going up, 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 and you start seeing that there are more real estate agents than there are deals for 4 real estate agents per deal, whether you're seeing that everybody, including your neighbors, seems to have bought rental properties, when you're seeing that, now here are the true indicators, the other two are just sort of situational. The next true indicator is if the price per square foot of an existing property is almost the same or only slightly less, literally within spitting distance of the price per square foot of new construction. When those two lines are threatening to touch, that means your demand is so high that the market should start to look at churning. Will it go another 3 to 6 months? It might go another 3 to 6 months. It might even go a whole another year before it actually churns. But when those two are that close is when that's your indicator that if you're trying to sell at the top of the market right before the market churns, that's one of your powerful indicators. Thanks to Bruce Norris and the Norris Group, if you're looking for true economic data and being able to track that and get economic education on how to track a market, the Norris Group is your place to go. It's literally norrisgroup.com. That's one. 2, also thanks to the Norris Group, is that in Southern California, he likes to use something called the affordability index. And he says in Southern California, he likes to get to when the affordability index gets to 12%. That means 12% of the population with median income can buy a medium priced home. That's going to be that's generally for some reason, we don't know the reason, but generally for some reason serves as a trigger or an indicator that the market is going to be turning soon. Okay, let's say you missed the beginning of the turn of the market. Let's say you missed these indicators. Let's say you missed pending sales are going down for 3 to 5 months in a row, and then you missed that. So now we're seeing that the flow has gone through this high compression of prices, which I already told you about. Pending sales decreasing, but prices remaining level is a good indicator that the market is churning, but it hasn't hit prices yet. Why hasn't it hit prices yet? Because there is a month to 3 month lag in closing deals. So pending sales decreasing happens before prices show that they've decreased, because prices that are decreasing are sold. That's a month to 3 months later. So pending sales gives you an indicator that you're at the top of the market. And if they go across and then start decreasing, and prices remain the same and are not increasing, that generally means you're heading towards the top of a market. 2015 is the only time where I have seen that fail. Where 2015 we saw pending sales going down, prices were flat, and the market did not go down. It actually collected steam again, but it was almost like it was meant to go down, because that ended up being an incredibly long run in real estate prices. So it's gone up, flattened, and went up again. So I think it was meant to be a downturn, but because of regional effects, it didn't happen. All right. So pending sales, another indicator. The final one, let's say you completely missed it. And that's fine. I've completely missed it. You might completely miss it, especially if you're a more passive investor, you may completely miss it. Let's say now you miss it and all you've got is housing prices. That housing prices have gone down. How long does it take? It takes 3 to 6 months before you can get the indicator that housing prices have actually sincerely gone down. Okay, we have 3 months worth of data showing us a decreasing price in an appreciating market. And then it takes another month to 3 months to 3 months for you to notice this is occurring and feel confident that this is a true event. So now you're looking to sell your property. Usually by 6 months in, 3 months in, real estate agents and investment professionals have started to notice that the market is starting to turn. They're starting to get nervous. 6 months in, it's now hit the LA Times. It's hit the larger papers. It's being declared, yeah, guess what? We think we've gotten a turnaround. Now the general public is more aware that there is a decrease in the market. What does that mean? Okay, let's say you're selling your house, your appreciated house or appreciated rental, whatever you have, because I'm really focusing on residential, by the way. I meant to state that at the beginning. This is residential. Now it's true. These charts are true across multiple different property types. So the indicators are very similar across multiple different property types. But what I am most knowledgeable in is residential. Multiple forms of residential, but residential. So take this with a grain of salt. Let's say you miss the height of the market. Let's say you're truly 6 months after the height of the market has occurred. Now the general public understands that prices are now decreasing, demand is decreased, people are more hesitant about purchasing it at a full market value because they know it will continue to go down. In a depreciating market, it appreciates 4 to 5 years, but it does depreciate a good 2 years potentially. Sometimes 18 months, sometimes 2 years, sometimes 3 years. Okay, guys, so there's a window here. Look at the charts, it'll tell you. It will appreciate potentially another, let's say around 2 years, 18 months to 3 years. They don't want to buy that at today's market price because by the time they close escrow, a month to 3 months after they've put in their offer, they will close escrow. The house is worth less. It's worth 3 months less of the depreciation they're seeing in the market. So if you put your house out at exact current market prices for this month, there's a good chance that your house will lag on the market. And it will lag for a month to 3 months before you go, I can't seem to sell this house. I want to sell it, or this multi-unit or this fourplex. I want to sell it. I want somebody to buy it. Now I have to decrease my offer, my listing price by the 3 months I've just lost to current market prices. Well, there's a very good chance you're still not going to sell because you're at today's prices. Why? The people who are looking to purchase your house, who are looking to purchase that property, know, whether it's conscious or unconscious, that the prices are going to continue to depreciate over the 3 months that they're in escrow. They don't want to pay today's prices for a depreciating house. Solve the problem. Believe me, I've sold in a downward turning market, and I've chased the market down, chased it down. Don't chase a market down. It feels bad. So just price it out at 3 months ahead of the current discounts that are occurring. Literally go, okay, what is it worth today per square foot? How much do I think it's going to be worth in 3 months as the market continues to depreciate at this speed? Put it out at that price. You'll get an offer. You almost always will get an offer unless there's something wrong with the property. You will almost always get people's attentions because you should now be in the lower end of the bracket that effectively are the comps for your property, instead of at the top end of the bracket that are the comps for your property. 3 bedroom, 3 bath with a pool in this neighborhood. you should be one of the lower end prices in that bracket that is comparable properties for other 3 bedrooms, 1 bath with a pool in the same condition. That's how you don't chase a downward market, downturning market. It's a real thing. Trust me, I've done it. So appreciating markets are a pony. They have a particular dynamic to them of the value going up, the value going down, pricing out when you're going to purchase, pricing out when you're going to sell. Very important in the appreciating market. That's what I'm going to cover today. I will do another video on appreciating markets. Thank you. This is Christina Suter with the Real Estate Breakthrough Show. Thank you so much for tuning in today. You can find us on iHeartRadio, YouTube, Roku TV, Spotify, and a variety of other platforms. Talk to you next week.